0.25%. That's all it takes. One small adjustment by the Federal Reserve, 0.25%, and suddenly mortgage payments jump, stock markets swing, startups freeze hiring, and governments quietly rewrite their budget forecasts. It sounds technical, harmless even. It isn't. Interest rates are not just numbers on a screen. They are the control system of the modern economy. Right now, interest rates in the United States are at levels we haven't seen in more than 20 years. Mortgage rates that once hovered near 3% surged past 7%. Credit card rates climbed above 20%. For millions of Americans, debt became dramatically more expensive almost overnight. But here's the uncomfortable truth. These rates aren't natural. They are set, engineered, adjusted. To understand how, you have to start at the center of the system, the Federal Reserve. The Fed doesn't directly set your mortgage rate or your car loan. Instead, it controls something called the federal funds rate, the rate banks charge each other for overnight borrowing. It sounds distant from everyday life, almost boring, but this single rate is the anchor. When it rises, borrowing costs ripple outward. Banks pay more to access money, so they charge you more. Businesses face higher loan costs, so they slow expansion. Investors demand higher returns, so asset prices fall. It's a chain reaction. Think of interest rates as the price of money itself. When money is cheap, people borrow freely. Companies take risks. Housing markets boom. When money becomes expensive, caution spreads. Projects get canceled. Layoffs creep in. Growth cools. And here's where the math gets uncomfortable. The U.S. government carries over $30 trillion in national debt. Every percentage point increase in rates means billions more in annual interest payments. So when rates rise to fight inflation, the government itself pays more to service its debt. The system disciplines inflation while quietly increasing pressure elsewhere. Meanwhile, not everyone pays the same price for money. Large corporations borrow at lower rates than individuals. Governments issue bonds at scales ordinary borrowers can't access. Your credit card might charge 20%. A major corporation might borrow at a fraction of that. Access shapes advantage. During the decade after the 2008 financial crisis, rates stayed historically low. Cheap money fueled a massive stock market rally. Tech valuations exploded. Real estate surged. Risk was rewarded. Then inflation hit in 2022. Rates climbed rapidly. Suddenly, the same cheap money environment that inflated asset prices reversed. Housing slowed. Venture funding dried up. Markets turned volatile. Low rates inflate. High rates compress. But the hidden layer isn't just about inflation or growth, it's about expectations. Markets don't wait for the Fed to act, they anticipate. If investors believe rates will fall next year, stock prices may rise today. If they expect tightening, borrowing costs can jump before any official decision. The system runs as much on psychology as policy. And that's the paradox. We're told interest rates are a tool to stabilize the economy, neutral, necessary, technical, but they reshape wealth, risk, and opportunity every time they move. So when you hear about a rate hike on the evening news, it's not just a financial update, it's a recalibration of who can afford to borrow, who can survive the slowdown, and who benefits from the next cycle. The real question isn't whether rates will go up or down, it's whether we truly understand the system that decides the price of money and who it ultimately protects when the cycle turns again.